Ladies and gentlemen, welcome to this interview with Performance Shipping. My name is Carolin Roth, and I'm really excited to talk to this company today because this really goes to the core of what 2020 was all about in terms of the economic impact from the pandemic. We know that the pandemic really wreaked havoc on global trade. So it's really fantastic to talk to this company today, which is very active in a subgroup of the global shipping market in the crude tanker rates. Let me introduce Mr. Andreas Nikolopoulos, the CEO of Performance Shipping, along with his right hand, Anthony Agiropoulos, the CFO. Thank you so much for being with us today, gentlemen.
Thank you, Carolin.
All right, good afternoon to you. You are sitting in Athens. I'm sitting here in Germany. So it's great to kick off this conversation about really what we can expect from the market in 2021. Let's reflect first on 2020, though. And Andreas, you've only been the CEO of this company for a couple of months. In the really hectic days of March and April, you were still the CFO, so you were extremely close to the business still. Talk to us about what you saw in the market at that point. How bad was it in terms of demand and tanker rates? Because I'm assuming it wasn't so bad, was it?
Indeed, it wasn't so bad, Carolin, actually. In March and April, you had this phenomenon by which the oil price went at all times low. I don't know if you remember that. And while it was at all times low, that was a very good opportunity for traders all around the world to use tanker vessels, crude oil tanker vessels, as a speculative manner, and in order to store oil for better days for the oil price. So actually, using those tanker vessels, what is called in our jargon contango, made the charter rates go at very, very healthy levels. And you saw this very peculiar situation whereby you had these global unprecedented times that we're living since more than a year now, nearly a year and a couple of months, where all markets are at all times low. But yet again, at the beginning of the year, the tanker markets were very, very healthy, and we managed to make very good profits due to this situation of low oil prices and people speculating and using our vessels to store oil for better days to sell them later on during the year.
Mm-hmm. Now, you don't need to be an OPEC watcher to know that there was so much volatility in the oil price over the course of the year. And for the better part of 2020, the oil price was well below $50 a barrel. So the second half of the year looked decidedly different, in part also because the price war ended. So talk to us about what happened then.
Indeed, the second part of the year was much, much different. The oil prices came back to a normality. So therefore, storage went away, as one would expect. And then that's where we started really feeling this crisis and the impact of the pandemic with charter rates that went back at low levels because activity is at very low levels overall. And that obviously impacts as well our industry. Having said that, we made a lot of changes in our company that I guess we will talk about a bit later. And we are very well armed to wait for the next recovery and better times that I hope are going to be coming back very soon among us.
Mm-hmm. Anthony, why don't we talk about some of the changes and really just in a bigger sense, your response to the crisis, specifically when you really felt the brunt of the impact of the pandemic in the second half of the year. How exactly did you respond? And again, it must have been really difficult for you from a perspective of as the finance chief, given the cash flow situation.
Well, we found ourselves in a transition period in the middle of the year. We were still delivering our container ships as we were exiting the container ship sector and still taking delivery of tankers. That was very challenging from an operational point of view, and Andreas will discuss that in further detail later on, given the pandemic. But from a financial point of view, the company's situation was quite robust. We had ample cash. Don't forget that the first half of the year was extremely positive for the company. During that tightness in the market and high rates, we managed to charter one of our vessels at a very good rate, $20,000 a day, to an oil major. And as a result, we're not that concerned about the financial ability of the company to withstand a prolonged period. In general, our our leverage policy calls for a specific target of 35% leverage. That's the maximum level we can have. So with that, and the robust cash position, we're quite comfortable as we moved into the second half of the year.
Mm-hmm. And we'll talk about that in more detail later on in this interview. But I want to come back to you, Andreas, and get a better sense of how you dealt with the difficulty of staffing during these last, 8-9 months or so, because we know from so many reports that so many crew members have been stuck at sea. They haven't been able to get home. There were a lot of social distancing rules. Many of them also got sick. So how did you deal with that?
You understand that for us, crew members are extremely, extremely important. Not only their health, but also their mental health is extremely important. And it's, of course, very difficult. Their job is extremely difficult, and it's very difficult for them to be at sea for such long periods of times, let alone knowing that they might not have this flexibility to move around as they used to have before the pandemic. Having said that, I'm very proud to say that we've managed to achieve quite a few things during this pandemic in regards to that aspect. First of all, as Anthony said, we got the delivery of 3 tanker vessels, and we delivered to their new owners our 2 last containers. As you know, we moved from the container ship segment to the tanker segment of our industry. And this was not easy. It's much easier said than done. You understand that changing crew, bringing our crew versus the crew of the sellers of those vessels was extremely difficult. Finding the right port to do that, because most ports were under lockdowns. Getting in the crew from as remote places as Philippines or Ukraine, bringing back the old crew, all that was not easy. But the team here managed to do that successfully, and we're very proud of that. Together with that, the crew that is for longer periods on vessels, we always try to find solutions to be able to change that crew so that they can go and see their families again, and of course, taking care of all the measures that are needed in order not to have any case that could be more problematic.
Right, and that's very, very important. I want to come back to one topic that you gentlemen, you've already touched on, the issue of rates. And obviously we know that over the course of the last couple of months in the container part of the business, rates have really gone through the roof, in part because a lot of capacity has been taken out of the market and there's a lot of demand for Chinese products coming from American consumers, but you've decided to exit that business before the pandemic started. Obviously, in hindsight, I don't know whether you would make the same decision, but the rates in your business now, they're at rock bottom. They're at around $7,000 a day, which barely covers the daily operating costs for a crude tanker. So what's your outlook here in terms of when rates will recover and what the key determinants are? Anthony, maybe.
Well, actually, we can both discuss about that. The key determinant for rates, and I will let Andreas mention about the container sector, is the supply of ships. That's really what drives the cyclicality in the business, because demand, bearing the shock that we saw this year due to the pandemic or other types of one-time shocks, grows every year at a steady pace. What drives prolonged periods of low rates or prolonged periods of high rates, as the period that we expect to be in soon, is the supply of ships. And currently, what's very encouraging is that the so-called order book, meaning the ships that are on order to be built, represent less than 8% of the fleet, and that is the lowest level in a quarter century. So that bodes very, very well for the foreseeable future for the sector. In terms of rates in the container sector, I'll let Andreas handle that.
Well, first of all, I want to reassure you that we wouldn't have changed our decision because we also follow the markets. We follow the fact that container ships rates went through the roof the last couple of months, but we would not change our decision. Why? First of all, because we went into tankers consciously, and the reason is that the tanker segment is more mature, more volatile, and more fragmented than the container ship sector. And this can bring, we feel, enhanced returns to our shareholders. Something that the container ship, because of some structural changes that happened to it in the last, let's say, 5 years, we really felt that would not enable us to achieve that. So despite the cyclicality of both markets, by the way, which we are used to being in shipping, shipping is a very cyclical industry, we are very comfortable that the returns achieved by tankers are historically much higher than the ones that are achieved by container ships. So I would say it again, we would not have changed that decision an iota.
If I may add, one thing is that in the container ship sector, there are two trends. One is the jumboization of the ships. Okay, what that means is that 15 years ago, a 5,000 TEU vessel, meaning a vessel that can carry 5,000 of these boxes that you see on the highway, right? 20-foot containers, was a very large ship. In the last 10 years, there have been a number of ships built that carry anywhere from 10 to 20,000 of these containers. That's number one. Number two, a very important factor, is that the multiple of trade volume in the container sector used to be at up to 2 to 3 times the rate of global growth. Okay, so there was a multiplier effect mainly because of offshoring. Okay, making things away from where they were being consumed. And this trend has actually, with reshoring, has reversed itself, and the multiple now has shrunk to 1 times. So these are longer term trends that I think will affect the sector, and that's why we exited the sector, among other things. Andres mentioned one interesting thing, which is we like the sector because it's volatile. And of course, you would say intuitively, why would you want to be in a volatile sector? However, we believe that the volatility, if managed properly, via the right chartering strategy, the way of employing the assets, the right financial strategy, the right dividend policies, can be taken advantage of and result in very, very attractive returns that we'll mention later in the presentation.
If I may just add, we talked about the supply of tanker vessels being at all times low since 1996. It's important to also talk about the demand. Indeed, we feel that the demand will come back to normality, to more robust levels, now that the vaccines will roll out and the oil consumption will come back to also more healthy levels. So that's why we're pretty confident that this demand-supply balance that exists today, and which whereby there are more ships available than ships demanded, soon will reverse, and we're confident that the market will come back to normality.
Gentlemen, you both raised a number of very important points, and I want to pick up on something you just talked about, Andreas, and that is the discipline in the market in terms of supply. And let me just stay on that topic for just a second, because in the past, industry cycles have very often been, cut short by ordering new ships from shipyards. What tells you, or investors at large, that this won't happen this time, that this won't happen again, that the discipline is here to stay?
Nobody can be sure that it will not happen again. We need to be honest about that. This is the essence of the shipping industry. Having said that, we feel that some financial investors that came by the first time around and basically massively ordered ships, not only invested in shipping companies, but ordered themselves ships, have been burned and realized that it takes some additional skills to manage the ships you order. So we feel that a massive reordering is not a massive threat at the moment, is not an immediate threat. Also, you must not forget that it takes 18 to 24 months to get delivery of a new order that you place. Therefore, the impact is never immediate. So it leaves you time to plan your next moves.
Mm-hmm. And Anthony, let me come back to you when it comes to the demand side. Andrea said there's plenty more optimism, obviously coming from the vaccine front. Also, Brent is back above $50 a barrel. Last time I checked, I believe 52, I believe, or maybe that's too optimistic. So where do you stand in terms of what the main drivers are of demand? Is that really just going to come from China because the rest of the world or the Western world is still going to be mired in this recession relating to the pandemic? Where is this really going to come from? Or is it going to come from, jet fuel demand because people are going to be traveling a lot more as restrictions are lifted? Talk to us about the key factors here.
Yeah, there are a couple of things. Obviously, transportation demand is very, very important element. And we do see that as people return back to traveling again, and the expectation is that despite using, all these media, Zoom and Teams and all these other things, people lived in a certain way in the past for a reason, because they prefer to do that. They prefer to travel. They prefer to have first-hand meetings with people, etc. So we think we're quite optimistic that with the vaccine rollout, there will be more traveling taking place. Also, the economies, oddly enough, both in Europe as well as in the United States, have fared far better considering the level of the pandemic and the disruptions in economic activity. And a lot of indicators, purchasing managers indexes, etc., are indicating that. So it's not just the China recovery. The third aspect that leads us to believe that the demand will be quite robust is the huge fiscal stimulus that is taking place and will result, I believe, in a significant upturn in global consumption, including oil consumption or refined petroleum product consumption. The one thing, of course, going now more to our industry that people should be aware of is that very much like the airline industry, our industry has to do with what's called ton miles, right? So it's not so much that crude is being consumed, because if it's produced in the United States and consumed in the United States, there's no ton miles created. Luckily, the vast majority of extra production is moved by sea. And typically, we have seen the increase in the Atlantic basin, Brazil, the United States, all that oil is going east. And that is a long distance as opposed to the Arabian Gulf oil going to China, which is nearby. And this has resulted in an increase in ton miles that we expect to continue as demand comes back.
So, Anthony, you make a lot of points that are very positive for cyclical sectors in general. But when it comes to shipping, a lot of investors out there have been burned because this is an industry that has not earned back its cost of capital for the better part of the last decade. Why now? What's going to be different?
Yeah, a couple of things. The why now has to do with the fundamental situation that we are in, right? The historically low order book, the snapback in demand. And as I said, the main culprit, we don't have to be that smart about where demand will come from, because it does come. And oil consumption naturally grows anywhere between 1% and 3% a year, and ton miles follow that rate of growth, approximately. The main culprit is supply. And supply is relatively easy to read, and it's at a quarter-century low. Just to give you an idea, at the peak pre-financial crisis, the tanker order book was in excess of 50%. Currently, it's below 8%. The return on capital, admittedly, the last 10 years have been obviously quite challenging. And the reason has been very simple, is that the industry pre-crisis over-ordered. These ships in all the sectors, all four main shipping sectors, were delivered through, let's say, with some delays with the yards and restructuring of orders through 2012. And as a result of that, the supply of ships in the market over the last 10 years has been quite large. Now, having said that, in the tanker sector specifically, over the last 5 years, the 5 Aframax tankers we currently own would have delivered, albeit with volatility, $50 million of excess cash flow to be distributed to our shareholders over the 5-year period. Our current market cap is 25 million. So we find that still, despite the oversupply that existed in the business over the past 10 years, the returns through a disciplined policy were quite high.
All right, Andreas, before we dig deeper into performance shipping as such, I want to ask you a final industry-related question. And obviously, the goal to reduce emissions, that is felt across all sectors, across the global economy, but the shipping industry is a heavy emitter. So what are you doing at performance shipping in terms of getting those emissions down? The IMO has very, very strict targets of reduction of emissions of roughly 50% by 2050. Is that realistic? And again, what exactly are you doing?
Well, first of all, let's say that we need to say that the decarbonization goals or the decarbonization goals that are in place at the moment are fully met by the industry overall. We also need to stress that ocean shipping is the industry that produces the lowest carbon footprint per ton transported compared to other transportation means. So, for example, airplanes, of course, trucks, etc. Now, performance shipping is also fully compliant with all emission standards, as it is burning, as we are burning on all our ships, only very low sulfur oil, sulfur fuel oil. So that means that this sulfur fuel has 0.5% sulfur content only versus the high sulfur fuel oil that has 3.5% sulfur content, the normal diesel, for example. So we are fully committed to those goals. We are also living in this world and in this planet, and we are not any way different. And that is why we will make sure that our industry adapts to any new goals that are put in place, either by changing the engines or by reshuffling our fleet or anything that is needed. We will comply as we have always complied industry-wide.
But what you're transporting is fossil fuels. In a decarbonizing world, how much demand is there going to be for that business?
We strongly feel that there is going to be, for medium to long term, robust demand for the type of products we transport. But don't forget that at the moment we are in the Aframax tanker space, but the overall tanker space has also gotten other types of vessels, like clean product type vessels, which we have not ruled out to be part of our fleet. At the moment, we have chosen this particular type of vessel in our segment of the industry, which is the overall tanker industry. But that does not rule out that we could buy an LR2 vessel. It is becoming very technical now, which is basically the same size type vessel, but transporting cleaner products. At the moment, we are focused. We have 5 vessels. We see a very good demand and supply fundamentals, like we have said extensively before. And but we are adults about the evolution of the world, and we are there to adapt if need be.
All right, Anthony, back over to you. And I know you do this all the time, but I want to hear your pitch to investors. I'm sure, when investors see this, they'll be thinking, hey, the fundamentals looking good. Maybe shipping isn't such a bad place to be. Why should they invest in you and performance shipping? Why not with a competitor?
Yeah, the difference is, and this is actually the vision that Andreas and I have, is that the difference is not so much in the assets that we have. Obviously, they're assets that we selected, high specification, good condition, we maintain them well, we run them well, etc. The main difference in performance shipping is the combination of our various strategies. So one strategy that's very important is that we predominantly operate in the spot market. So we're not afraid to actually experience the level of volatility in the sector. We don't try to manage that volatility. We may pick our points to select some medium charters, but yes, our EBITDA, if you will follow the volatility in rates. The second one is, as I mentioned, is that we have a low leverage policy. This is fundamental in maintaining a reasonable volatility in our stock price. It will be volatile, but it will not be unduly volatile as it is with our competitors, the other public companies. The third one is that when our rates are above our break-even level, we actually have a policy where we specifically distribute those extra cash flow to our shareholders. Just to give you an idea, in the last 5 years, the average Aframax charter rate in the spot market is $20,000 a day. We have publicly mentioned that our cash break-even level is $15,500. So over a quarter, this means we generate $2 million of cash flow for our shareholders. Our market cap is 27 million. So we can actually generate an 8% quarterly yield just with an average charter rate environment. So the pitch here is that if you buy the stock, your through cycle returns, even at an average level, actually end up being about 8 to 10%, because we do have quarters that we don't pay dividends, etc. And we think that that's an attractive yield. In addition to that, we plan to grow our fleet substantially. It may sound too ambitious, but we want to be $1 billion plus company. We want to be the first call for people that want to invest in our sector through this very, very disciplined strategy. Effectively create an ETF in the tanker space.
It does sound very ambitious. It sounds like a great plan, but can you do that without issuing stock?
Of course we can't. And actually, we want to issue stock prudently, gradually, to specifically fund these vessel acquisitions. We believe that if we do that through the cycle, when our stock price is low and when our stock price is high, don't forget, when the stock price is low, we buy our assets more cheaply. When the stock price is high, we buy our assets more expensively. So ultimately, our pool of assets will have been bought at what's called the mid-cycle level, right? The average level. And based on that average level, which is about $22 million for an Aframax tanker of our target age, which is about 10 years, results in a yield of around $2.2 million annually, which is about 10%. So yes, we will access the markets in a prudent way, and we would like at some point to have a market cap in excess of $1 billion and with a reasonably low level of leverage, maybe $200-300 million.
Andreas, put your CFO hat back on for a moment here, because I want to talk to you a little bit more about the dividend model. In shipping, a lot of companies have done this, and they've been rewarded by investors because they were trading at a premium to their NAV. Now, you're hoping to do something similar with a variable business dividend model. Do you think you will equally be rewarded by investors in doing so?
If we remain, as we intend to remain, consistent with our strategy, which is one of a very simple financial model after all, we feel that yes, eventually we will be rewarded for that. We feel that eventually our share price will arrive close to our NAV, if not higher than our NAV. But for all that, one needs patience and perseverance, like many things in life. I think that we've rolled out this strategy only 2 months ago, and for the moment it's been going quite well. We've reshuffled the company completely. We've changed segments. We've simplified our capital structure. We have only one type of shares of common stock in order to be as user-friendly and shareholder-friendly as possible. We have a very clear, and we've explained that throughout this discussion, strategy in terms of our business model. And we intend to keep a low leverage, and we intend also to be very careful in the dividends, the way we give them to our shareholders, in order not to jeopardize our company. You see, the big problem with our peers or people that distribute dividends is that sometimes they get carried away. You cannot get carried away in shipping, because if you get carried away in shipping, because it's so cyclical, you might not be around during the next cycle. We intend to be around for many years to come. Our chairman of the board is 3 generations back ship owner. So he wants us to be here for the long term, and we intend to do that. So therefore, the dividends that we will distribute are going to be based on what we can distribute and when we can distribute them, reserving for the dry dock of our vessels and the replacement of our vessels. But being consistent in our strategy will make us, for sure, we are very confident about that, arrive to levels that are closer to our intrinsic value, and not the levels that you see today.
Mm-hmm. Anthony, finally, a question I want to put to you is regarding the ownership structure of Performance Shipping. The free float is relatively small. Should investors be concerned about liquidity?
Yeah, indeed. Look, the free float is about a little bit more than 50%, right? The main issue that we have, the stock is actually quite liquid. It trades about $800,000 worth of shares a day. The market cap is barely above 25 million. So the free float is about $12 to $13 million, and it trades $800,000 a day. So it's quite liquid, and we would like to maintain that level of trading liquidity. The challenge that we have right now is that our stock price is quite discounted. We trade a little bit above cash. We have $21.5 million in cash, and we trade about 40% of our net asset value. So the challenge is that we want to effectively, once rates recover a bit, and that's reflected in our stock, once the fundamental backdrop manifests itself among investors, we would like to, and we perhaps would pay a couple of the quarterly dividends. Then hopefully that's reflected in our share price, and we issue equity to bring effectively more investors into the stock, create a wider shareholder list, if you will, increase the free float, and hopefully continue to have a quite active, trading activity in our stock, with a lot of liquidity. So I think it's a step-by-step process. Right now, there's a lot of interest among investors to invest in our company, but they can only invest very small amounts because of the market cap and the share price. One thing that I would like to say, if I may, and I invite the people listening to actually see our presentation on our website at some point, is that if you look at the last 5 years, and it's the same in the last 10 years, or the last 15 years, half of the quarters are basically quarters where we operate below our break even, and the other half we operate above our break even. The interesting thing is, and this is something that you can only achieve with patience in the cycle, is that when you are above your break even, the volatility is such, because our break even is near the lows, that you earn anywhere from 3 times the money you lose when you're below your break even to 7 times, depending on where your break even is. So if you're patient in the sector, you can actually make a decent mid-cycle return or a very high return if you try to time your entry and exit.
Andreas, a final question to you, and I put this question to a lot of CEOs. Sometimes they're comfortable answering, sometimes they're not, but I'll just put it to you. What's fair value for your stock price?
That's a difficult one. I agree with you, because I believe that fair value in our stock price is, as our industry is, volatile. Today, we clearly feel that a fair value for our stock price is around the $14 mark. And that's what we feel for today, where the values are with our debt level, which is low, and with the assets that we have in our fleet.
Gentlemen, I want to thank you so much for this. What is thank you in Greek again?
Ευχαριστώ.
Okay, I'll work on that pronunciation, but I want to thank you so much for your time. And I do wish you the best of luck for 2021, and do stay safe and stay healthy. Thank you so much. Appreciate it.
Thank you very much, Carolin.
Thank you.
We really appreciate it. Stay safe as well.
Thank you. Take care.
Thanks.